All right, we're back with another stock analysis, and today we have Vertiv Holdings, ticker symbol VRT. Now, why is this stock so popular in the news right now? This stock has been announced to be added to the S&P 500 within the next few weeks. I believe it's March 23rd, and VRT Holdings will be added to the S&P 500. So a lot of people are going to be excited about this stock, along with institutions who have been pouring in funds to support. So right now, this stock is about 80+% institutionally owned, which we expect for strong growing companies that's going to be added to that index. So here's the thing. This company provides power and cooling solutions primarily to data centers. So of course, this is why they're going to be outperforming over the past year, up over 50% since January 1st. So that's why this stock is popular right now. So we're going to get into the fundamentals of this stock to see if we feel the same way a lot of people feel about this stock as this pure data center support play here. So let's get right into the stock analysis. Looking at the chart, we see they went public in 2020. So we have limited history to look at, but very strong stock trend, especially since they kind of bottomed last year on that downfall, but they've rose up pretty well. Some significant volatility during that time period, but overall we see a strong uptrend right now, trading at $258. This company is at a $99 billion market cap, PE ratio of 75, so pretty expensive based on the price to earnings ratio. We'll look to see if that's justified by the fundamentals, and even paying a dividend. This company is paying a dividend of 0.1%, so a small dividend, but it is paying a dividend. For reference, this company, I believe, started in the 90s, so they're not a new business, but as far as supporting power solutions and cooling solutions to AI data centers, this company is getting a lot of attention. Went public 5 years ago, and this is where they are now. So with that said, let's get into the fundamentals of this business. The product mix. This company is about 82% product that they deliver to the data centers and 18% service. So once their products are in a data center, they have field engineers that are either on site or come in and visit to do some testing, monitoring, provide solutions, and to help fix things that if problems pop up. So primarily it's about their products to data centers, not the service, but they do have a service component. With that said, I believe their service component could grow as more data centers are built, of course, but you got to think about it. As data centers are being built, this company who owns about, I want to say about 17% of the market share as far as these solutions for cooling and power, when data centers are not being built as rapidly as they are now, what's going to happen to their primary business? This is a concern that investors have to think about, because a lot of the commitments to data centers, they pretty much fall off around 2030. So what is this company going to do after that? Also, we have to understand data centers, the way they're being built now, all the money that's funding them, we know it's not going to be permanently like that. When is that going to cut off? And is it going to cut off sooner than we think? What I mean is, our company is going to realize that they may be spending too much money. A lot of the commitments that they've been given to data center construction, they realize that's too much. We can just cut it off here and deal with the data centers that we have. That's something that's possible. A lot of these commitments are commitments. They can be taken off the table at any point in time. So this is a company that I believe is in solid position for the short term, but there's a lot of uncertainty regarding that later on. So again, they went public in 2020. So we're going to look at the last 5 years of financial statements. So 2021, 4.9 billion, growing all the way up to 10.2 billion for the 5 years. That's an 18% growth. That's pretty solid. And of course, this past year has been their highest year, as you would expect with their data center focus. Looking at gross margins, since they are producing equipment and delivering products to the data centers, I don't expect them to have 80 and 90% margins like some tech companies. So 27, 24, 32, 34. So growing gross margins, what we like to see as a company gets more established, and pretty consistent holding at that 34% for the past 2 years. Net income, 120 to 1.3. So the ratio, we got 2.4 all the way up to a 13% net profit margin. That is solid growth over these past years, as we would expect this, as data centers is the craze of the time. So quickly looking at their debt, comparing it to their free cash flow. How much debt is on their books? How quickly can they pay off that debt with the cash flow that they're producing each year? And we see 3 billion to 3.3 billion. So not consistently growing their debt balance, or not significantly, but let's see, we have negative cash flow 1 year. The other years we have positive. For the past 3 years, they're averaging 2.5. So that is great leverage position for them to be in, meaning in this past year, they can pay off their debt in 1.8 years, less than 2 years with the cash flow that they produce. But on average, past 3 years, 2.5 years to pay off their debt. We love anything under 3 years. So this is solid. Again, looking at their dividend, again, small dividend, not a lot that's being paid out, but a dividend nonetheless. 3.7% of that cash flow is allocated to a dividend right now. So 6 cents per quarter, about 24 cents per year, small dividend, but we would expect a company in this position to be paying a small dividend. Again, they went public in 2020, started paying a dividend right away as a public company. Not a new company, but a newly public company. And we see 50% growth, 66% growth. So we see some solid growth trends there. Again, minimal growth in dollar amounts, but significant in percentage. And with a low payout ratio, of course, we know there's a lot of room for them to grow to continue paying out that dividend. So we like to see that if a company is paying a dividend. Another thing to note with this low payout ratio, that's a lot of cash flow that can go to debt acquisitions, reinvestment to the company. So they're very flexible. They can continue to grow this dividend a few cents per year, not make a big splash or a dent in their cash flow that's already growing right now, and they can use that for reinvestment. So great position for them to be in as far as their capital allocation options that they have. Shares outstanding. We like to see this go down, but again, new company, I keep messing that up. Newly public company in this new industry, and they have a focus that they're dialed in with the data centers. So I would expect some of this to go up, but one thing to note, pretty flat. I mean, the minimal growth over the past 3-4 years, not significant. So they're pretty holding strong there. This uptrend is basically because of these first 2 years here. So not a big deal. So pretty solid, not really growing their revenue or growing their shares out of proportion. Pretty consistent. So I will say I like to see that. Let's look at their cost of capital compared to their return on capital. How much value is this company creating economically each year? Looking at the last 5 years, we have a return on capital. Their profit compared to the capital that they have at their disposal to invest into the business, 11.6. Cost of capital, 7.6. They have a value spread of 4%. So this is saying economically they're growing in economic value by 4% on average over the past 5 years. So that's a good thing to see. With that said, let's look at the discount cash flow results and see what I think about the true intrinsic value of this business. So projected to grow 25% each year over the next 5 years, which is excellent growth if they can maintain that. Cost of capital, 7.6. So that's going to be my discount rate. Assuming that if I were to buy the stock today, in 5 years, I can sell this stock and the market cap would be about 20 times their current free cash flow. With the price at 258, I'm estimating the true value of this company to be at about 197. So I want to show you something. This is my opinion of what the company is worth. With this said, I do believe there's a lot of support for that stock to continue to climb, especially for the next 3 years. Probably not as sharply as it has been. Again, we're looking at 56% growth this year already in this March. So probably not as sharp, but I can see the stock staying steady or continuing to grow steady over the next 3 years. So with that said, that's what the price is. It's not necessarily saying it's worth that much, but this is just my estimate. So 177 to 217 is my personal estimate. So now, just to give you some reference, if you are higher on the stock than me, you may say, hey, I believe you can get 25 times free cash flow instead of 20. We know tech companies that are doing well, even though this is a product manufacturing business, tech companies, hey, they might trade at a higher valuation. So you may say 25 times free cash flow if that's your opinion. With that said, you believe about 238, fair value range high about 262, you're right in range at that time. So if you are more confident in the stock than I am, this stock is fairly valued according to that opinion. But if you have a more cautionary view of investing like me, then you would think this stock is a little bit overvalued. Again, I do believe the action of the price is going to continue to be positive, but again, that doesn't mean that's what it's worth. That's just what the price is. Now, my issues with the stock right now, they are public for 5 years. So we have a limited history to look at. We got 5 years of financials. Typically, I like longer trends to look at, so I'm sure about what I'm buying. Second, they have a singular market focus. 82% of their revenue, as we saw, is delivering products to data centers. When it comes to their competitors like Schneider or Eaton, who one have largest shares of data center providing products in those areas, I believe you got, I think Eaton is about 19-20%, Schneider might be about 20%, and then Vertiv is 17%. So they're close up there with the top with the big boys. However, they're not the biggest boy out there. And those companies are diversified in their product offerings. Vertiv is data center focused, which is why they have a lot of momentum right now. But there's a lot of risk to that, because with that concentrated environment, like I said earlier, some of these commitments to build these future data centers can go away. Then what? If they're so focused on AI data centers, what are they going to do if that goes away? Or again, once these data centers are being built, when that starts to tail off, what are they going to do? They're going to have to focus more on service, and with them not having the largest market share, what does that mean for this business in the future? So I think they need to diversify their offerings a great bit to be solidified as a company I would say is pure quality. So they don't have much of a competitive advantage there. So that's my main issues with Vertiv and why I'm not as high on the stock as a lot of people are. My intrinsic value estimate about 197, 217 on the high side, with the caveat that there is a lot of support for this stock to grow over the next 2 to 3 years. I believe fairly easy and consistent. So those are my thoughts on Vertiv Holdings. Let me know your thoughts in the comments, and I hope to see you in the next video.